Okay, trivia time. Time is on the clock. Name 5 things that automatically come to mind when thinking about wealth management or financial advisors. Ready? Go.
That's easy. Bored, painful, rather listen to my in-laws, numbers.
Almost there.
Torture?
We have a winner. Let's tell him what he's won. You've won the PennyWise Financial Podcast. Yes, it's a financial show, but we talk to you like human beings talk. Sure, we do the traditional retirement planning and money management, but we also help plan for other decisions, like buying a car, selling a home, buying vacation properties, or selling a business. We're more than financial advisors to you. PennyWise Financial, brought to you by Monarch Wealth Management. This is PennyWise Financial, and this is Constantine Katrinos.
Good morning and welcome to the PennyWise Financial Podcast. Constantine here, Managing Partner, Financial Advisor at Monarch Wealth Management. My guest host, Jason Giorgio.
Hello, everyone.
Good morning. So, today we're going to talk about one of the nasty, dirty, evil words that we use in our business. It gets a horrible rap. It really does. Jay, what are we talking about today?
Annuities.
Annuities.
Yes.
You hear that word, you want to run for the hills. What is an annuity? How does it work? What are the fees? Why would I own one? Should I own one? You see the ads on TV, right?
Mm-hmm.
You see the green guy screaming if you have an annuity, run for the hills. I will die and go to hell, or whatever he's going to do. I'm not sure, but so there's definitely this misconception of what they are and how they work, and I think a lot of the problem stems from education. What actually is, what is this kind of investment? Why do I need it? Who is it right for? So let's dive into the crux of that. Excuse me, and talk more about why somebody might use this as a part of their plan. What do you know, Jay, so far about annuities?
Well, I know annuities provide lifetime income for people, and it's not investments. It's a contract between your client
and an insurance company.
That's
right.
Company.
That first of all, let's stop there and let's talk about what that means. Essentially, with any of the investments that we do have, if they're stocks, they're bonds, or ETFs, or actual investments in companies, you own a share. You own part of that company, right?
Mm-hmm.
All right. So when they are profitable and they're doing well, you make money alongside of them, right? And you might want to support some of those stocks and bonds, right? So if you own Apple, you own the Apple stock. Maybe you have an iPhone. Maybe visit the iTunes store, or maybe you go and buy accessories and things like that, and you profit from that. So you're supporting your cause. When you have insurance contracts, it's an investment. It's a direct contract with them, right? So in that case, when you mention it's a contract between the investment or the insurance company, the contract, all the guarantees are driven from them. So they're not determined by me. I don't go out and say, let me give Jason this guarantee. Right, and not a lot of investments that you can actually talk about actually have a guarantee, right? So you have to be careful about what you're saying and how you educate the client and knowing what they're actually buying, because it is a purchase, and there's a cost to it. And so there's a number of different types of annuities. One of the things that you mentioned was a guarantee, and a guarantee on income is the specific thing that you were looking at as far as guarantees, and that's one type. So these are offered by insurance companies. How many insurance companies we work with? 10, 20, 30, 50, 100, you name it. So we have a vetting process, right? So that's important. You have to make sure that the insurance company is sound, is stable, is going to be solvent, right? Because if they're not, obviously those guarantees are backed by the claims paying ability of the insurance, right? So you've got home insurance, right?
Yeah.
You've got auto insurance.
Yeah.
Now, homeowners insurance, if you don't have a mortgage, you don't technically have to have that policy, right?
Yeah.
House burns down, no insurance, house is paid off, well, you're kind of SOL, right?
Well, with homeowners insurance, or is it the PMI, the mortgage insurance?
So if you had, I'm not talking about PMI. So
Okay.
PMI or MPI, that is not to protect you in any way.
Yeah.
If you are not able to pay your mortgage, that type of insurance is really going to protect the lender, right? And then once you reach a certain amount of equity, it could fall off. The new FHA rules are different. We'll have to get a mortgage lender or broker in here and we'll talk about that. But no, I'm talking about homeowners insurance.
Okay.
So the type of protection, like if there's a flood, if you have any damage caused by wind or earthquakes or whatever it might be, that type of insurance is not a mandate if you have the house paid off. So maybe it costs you $500 to $1,000 a year to protect your investment, which in upstate New York might be $150,000, $200,000 for an average house.
Yeah.
Right? It's not required. But auto insurance is required. At least some of it is. Liability, where if you hit somebody, they want to make sure there's some money that can be paid out to protect the other people, right? Not necessarily to fix your car, but to keep them safe. So the reason I bring that up is those are all contracts with who? Insurance companies, right? So you pay your premiums, and you know that as long as the claims paying ability of the insurance company allows them to remain solvent, they're going to pay those claims. You get in a car accident, you pay your Hartford or your Nationwide or your Allstate insurance. They're going to be there to...
You're covered.
You're covered, that's right. You're not worried like, geez, if I pay this premium, they're going to go out of business, right?
Yeah.
Now, New York State has all kinds of other regulations. We're not going to dive into the red tape, but additional type of protections, if you will, to help make sure that those investments and those insurance companies do remain solvent. So cash reserves, things like that, the way that they have to invest their money. But if I could start any business from scratch, it would be an insurance company. It's a pooled risk, right? So you're transferring liability to someone else. And that transfer really is a transfer to the insurance company. And they win some and they lose some. And when I say that, I mean, they may take on a new client. They may pay premiums for a very short period and have, a claim to file. And they're on the hook for that. And then they might have other folks who've been with them for 30 plus years and never file a claim.
Yeah.
Right? So while we're on the claims, let's take a quick pause and we'll be right back with the show.
Do you have a high deductible insurance plan? If so, have you set up your HSA? There's a ton of people who don't know what it is or how it works. Even worse, there is an underserved segment of the population that can't get advice from their advisor about how to make the most of these powerful and unique programs. Not many advisors focus on this in their practice, don't understand the mechanics of how they work, or even where to begin helping their clients. Reach out to me, Constantine at Monarch Wealth Management, and I'll guide you through this process and get you on track to make the most of your high deductible plan in your superhuman HSA. That's 585-484-1400. That's 585-484-1400.
Welcome back to the show. Constantine here, PennyWise Financial Podcast, joined by Jason Georgia. Welcome back, Jason.
Thank you, sir.
So we talked about the insurance contracts and some of the guarantees. We started on that. So when you think about the transfer liability, you're paying a premium, right? It costs you money to protect an asset. Your house is probably one of your biggest assets you own, if not the largest. So you pay $500 to $1,000 a year to protect your house. That might be worth $200,000, right? So it's right around 1% or so, 0.5%, to protect this asset, and I think it's well worth it. Now, when we talk on the investment side, we mentioned the dirty word, the annuity word, right? Run for the hills. There is cost. So there could be some investment-like potential for returns with typically some downside protection. And depending on the type of contract, that's what people are really looking for. So there are some pretty basic, very conservative, straightforward type of annuities. Most people don't know what they are or how those work, but those would be on the fixed side. Do you know anything about the fixed annuity?
Well, the rate stays the same. It's a fixed rate, basically.
You got it. So it's really essentially a defined period of a rate that's specified. Could be a 1 year, a 2 year, a 5 year, a 7 year. So that's one part of the contract. But then there's a holding period, the CDSC they call it. You know what a CDSC is? I bet a lot of people don't. They might know it when they're meeting with their advisor or hear talk about it, but contingent deferred sales charge. So the fixed annuity is the most conservative, most basic type of annuity you can buy, right? It's a defined amount of money, a premium that you're putting in. Taxes on that are a whole nother ball of wax, but essentially they're tax deferred, right? Until you take money out. And then they have some wiggle room on flexibility of taking money out. So typically most of these contracts are 5, 7, could be 10 years. Some states, have you ever seen this? Have you ever seen a contract from Texas? Texas, I've seen some from Tennessee. They might go out to 10, 12, 14 years CDSE. Imagine an investment you buy that you have to hold on to for 14 years.
Before you can withdraw.
Before you can completely liquidate the whole thing without any penalty or contingent deferred sales charge.
But in the meantime, you're contributing to that, or you're not?
Possibly.
Okay.
Possibly. Depends on the type of annuity that you're looking for and the type of guarantees that you want. Some could be income-based. Some could have some tax benefits. Some could have some triggers for beneficiaries where you might not qualify for life insurance. That's a different type of contract. But let's stick with the most conservative, the fixed one. Put in a premium, say put in $100,000, pays you these days maybe 1%, I guess, 1.5%. For 5 years, that rate might stay the same. Each of these companies, these insurance companies, have their own rules. So you might have a contract that pays you 1.5% for all 5 years fixed rate. At the end of the 5 years, they can reset that rate. And there's typically a minimum renewal rate. They might do this on an annual basis. So it could go from your 1.5 down to, let's say, 1, which is their minimum.
Now, when you say pays, you're saying pays the client directly, either monthly, yearly, quarterly?
That's a good question.
Okay.
So they will credit the account that amount of money. On $100,000, 1.5%. Let's say $1,500. If you allow that money to remain in the contract, you don't withdraw it, your account is growing. So now your $100,000 is $101,500. That 1.5% is then calculated based off that $101,000, etc. You have the right, and depending on your age and things like that. So there's a bunch of different rules. 59.5 is extremely important.
Yeah.
To pull money out of an annuity, you have to be 59.5.
If not, 10% penalty?
You got it.
Okay.
You got it. So even though you have a set of rules from the insurance company, you also have a set of guidelines from the federal government, from the IRS, as well as New York State when it comes to tax. So your contract might be completely liquid, free. You've gone past the 5, 6, 7 years. And you might say, yeah, I want to take all my money out. Guess what? If you're not 59.5 yet, let's say you're 55, pull that money out, you could potentially be exposed to that 10% penalty. There's some caveats to it if you're disabled, things like that. There might be some other ways to get around that. But the taxes on it, so if you don't take the money out, the taxes remain deferred. Sounds like a great thing, right? Your IRA is deferred, your 401k could be deferred. But what are you doing if you hold on to that for a very, very long time? You're creating a tax bomb. Tax bomb. And what I mean by that is, if you have these pent-up gains, put in $100,000, it's worth 101, 105, 110, 120,000. Let's say you're now 59.5. Let's say you're 65, and you put in 100,000. It's worth 110,000. When you go to take money out, let's say you pull out 10,000. Any idea how much of that 10,000 is taxed?
Would it be all of it, or?
You got it.
Okay.
All of it.
Oh, okay.
So on an annuity, the tax treatment is different because it's been deferred, right? You're going to be forced to take out the gains first.
Oh, okay. That's why.
So think of it like a chocolate cake, right, with 3 layers.
Yeah.
The third layer is that icing, all the extra, that nice sugary tasting. That's the stuff you take out first.
Yeah.
The interest, the gains, any gains on that contract, that's what you take out and you pay taxes on first.
Yep.
After you've gone through that, let's say the following year you want to pull out 20,000. How much of that is taxed?
Zero.
It's your own money.
Yep.
Can't double tax you on it.
Yeah.
So that's a good point. So as far as the type of person who might want to invest in an annuity, you definitely want to factor in things like age, tax, right? So it's got to be part of a tax plan, because you can make a ton of money in an annuity or any type of investment. But what about the money that you actually keep when you pull it out, right?
Yeah.
It's not what you make, it's what you keep. So those are some things that you definitely want to consider. For somebody that's under age, I'd say even 50, 55, you might not want to utilize this. It might not be the best strategy because you'll be locking money up essentially until you're at least 59 and a half. It's a pretty long time.
Yeah.
Right? With that, let's take a quick break and we'll be right back with the show.
Are you a business owner looking for ways to save for retirement, keep and attract top talent, or maybe just save the amount of taxes you're paying? We have solutions to help all size businesses, from solo practice to mid-sized firms. There's a ton of tax incentives just up for grabs. Your employees will thank you for giving them a platform to invest in their future. If you have a retirement plan in place and you're not sure the best way to set things up, reach out to me, Constantine at Monarch Wealth Management, and I'll help you understand your options and know what you own. Not all advisors understand retirement plans, so make sure you're working with a knowledgeable team and experience the Monarch difference.
Welcome back to the show. Constantine here, PennyWise Financial Podcast, joined by Jason. Jason, we started talking about annuities and who the ideal person might be, or at least some of the people that may not want to consider this because of tax or age, things like that. So we talked about the basics of a fixed annuity. It's pretty straightforward. There's other types of annuities. I think that you have some notes written down about some things you wanted to address or talk about, maybe about annuities. Yeah. So what other things do you have?
Well, I know we have a variable annuity too.
Variable annuity. Okay, so that's where I think a lot of people get into trouble. And the trouble comes along the lines of a lack of education or understanding. And it's not necessarily the client's fault, right? It's typically the advisor's fault for not ensuring that the client really understands what they're buying, what they're investing in, what's really at risk, what are the costs, what are the fees. So variable annuities do provide clients with a ton of different things. You could have a stripped down annuity with just some pretty basic things like tax deferral, maybe a death benefit. So for a client that maybe doesn't qualify for life insurance, that wants to leave on a legacy for their wife, their husband, their kids, grandkids, whoever it might be, likes the idea of investing, let's say in the stock market or having investment-like returns, but wants to protect that money in case it goes down. So you got $100,000, I invested, things go well, 10 years down the road, it's worth, I don't know, $220,000. Everything is sunshine and rainbows. God forbid you pass away, the beneficiaries would now inherit that higher value, right? But what happens if things don't go so well? You put in 100,000, market cracks, goes down to 80,000 the year after, kind of sideways. Now it's down to 75,000. God forbid you pass away. The beneficiaries inherit what? The 75,000, right?
Yeah.
In any other investment. So the variable annuity would allow, depending on the contract and the insurance company, a death benefit, which says maybe it's a return of premium.
Oh.
And we refer to that as a premium because it is a premium. Like any type of life insurance, you're paying a premium for some kind of protection or guarantees backed by the insurance company. Same thing here. So with these contracts, you put in your initial premium, that could be a protected amount. Some of the contracts have bells and whistles, well, they'll lock in death benefits like every year on your anniversary, up to a certain age, things like that. These benefits change all the time.
Yeah.
What doesn't change is when you set up the contract, you have a list of guidelines on the benefits it's going to provide. Those don't get changed. So the new issues, the new contracts, so you might buy a contract, let's say today, 5 years from now, look to find the same exact offering. It might not be available. And we've seen benefits change over the years quite a bit. The cost for those benefits, again, misunderstood. Understanding what you can invest in. So they're not exactly the same. They're labeled or they're defined as what we call sub-accounts in variable annuities. So they get a bad rap for those reasons. They're misunderstood. What were the fees? What were the fees again? So when we have clients that utilize these that might want to protect either principal, might want to protect income, might want to protect a death benefit, might be looking for tax deferral. So here's another thing about tax. On any investment, if we were to go ahead and rebalance and make some changes in a non-retirement account, if there's gains in those changes, but we don't take money out of the account, how much of that is taxed?
Zero.
Well, actually, in an annuity, it would be zero because it would be tax deferred because it remains in that chassis. But in a traditional non-retirement account, right, a regular plain Jane account, even if you don't take money out of the account, but you rebalance and you sold off some positions that made money, you will get a 1099 for those gains, and you will be taxed on it.
Over $10.
Correct.
Okay.
Correct. So you might have some confusion about that. Inside of an annuity, you have some physicians that look to make changes and tweaks. They don't want to be worried about the tax on the other end. Mm-hmm. So there's some ways that you can set that up. And then there's other types of annuities that people might be familiar with and they think of. It's when they win the lottery, right? So you've got what? A lump sum payment option, and the other option is an annuity paid out over your life. Mm-hmm. And so there's tax ramifications. If you win $1 million in the lottery and you got to pay tax and all that stuff, what are you going to walk with? Maybe $600,000? $600,000 does not go a long way. Not today. Mm-hmm. If you're 50, 60 years old, you draw 4 or 5% from that. For the rest of your life, it doesn't accumulate to a lot or amount to a lot of money compared to a lump sum. So, compared to annuitized payments, which might be more tax friendly, but the downside is you may not live long enough to really reap those benefits. So when you think of annuities, there's fixed, there's variable, and then there's this other one, which is like an immediate annuity, which is along the lines of what I said. When you win the lottery, it's basically an immediate annuity, right? You've handed over a lump sum of money to the insurance company. They're going to guarantee a certain amount of money to you every month or every year for the rest of your life, right? Or it could be a given period of time.
Now, I was under the impression that both fixed and variable annuities could be immediate or deferred.
So essentially, a lot of these annuities, as far as tax treatment, taxes are deferred, right?
Okay.
As far as distribution of either principal and or income from those accounts, they could be set up to distribute income over your lifetime by annuitizing the contract. The whole word annuity is set up to define, or describe what people will use these investments for. I'd say 99% of the contracts are never annuitized. The word annuitize essentially says, I'm going to surrender the principal value to the insurance company, and they're going to give me a nice guaranteed paycheck, let's say, for the rest of my life. Mm-hmm. So that's kind of giving up the keys and saying, here you go, insurance company, here's my principal, pay me out as long as you can, as much as you can every month. They give you a defined amount, and that's it. So there's no going back from that.
Okay.
So it's kind of like a pension in a way, annuitized, but that really never happens. There's got to be very specific needs.
Yeah, but you can, when you do the annuity, you set it up as benefit, you have beneficiaries, and then you pass away. You can have a death benefit like you were talking about before. You pass away, the beneficiaries inherit that annuity, the base amount. But when you're withdrawing, that number is going lower, 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 lower.
Correct. Yeah.
Correct in that?
So you could take principal distributions. You could set up annuitization where it's a combination of principal and maybe a little bit of interest, but mainly is to pay you over your lifetime.
Okay.
We've only scratched the surface on annuities. I think we're going to stop here because we're probably making some people's ears bleed. But I think that's it. We're going to wrap up this session. Thanks again for listening to PennyWise Financial Podcast. Have a great day.
Thank you.
You've been listening to PennyWise Financial, brought to you by Monarch Wealth Management. Constantine and David really care about their clients. They want to make sure you're happy, so you'll continue to hire them. There's no commitments, and clients are free to leave whenever they want. Think about being able to pick up the phone and call someone for guidance and advice on almost anything, from buying a car, selling a home, buying vacation properties, or even selling a business. Reach out on the website at monarchwealthmanagement.com. There are 2 offices in Rochester and 2 offices in Buffalo. Reach out to us on Facebook, LinkedIn, Twitter, and YouTube, or call us toll-free at 800-480-1580. That's 800-480-1580. Until next time, this is PennyWise Financial, signing off.
The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA and SIPC.